You did everything right. You budgeted. You waited for the right time to buy, to refinance, to finally move your savings somewhere that pays. And the goalposts keep moving. Mortgages got pricier. Loans got heavier. The market got weird. Here's the thing. That's not a discipline problem. It's not you being bad with money. There's a single number quietly behind almost all of it, and most people have never heard its name. Today we get into it. The number is the yield on the 10-year U.S. Treasury. Right now, in mid-2026, it's sitting around 4.5%. When the U.S. government needs money, it borrows by selling bonds. A 10-year Treasury is just a loan you give the government for 10 years. The yield is what they pay you back for it. U.S. government debt is treated as a guaranteed return. So that 4.5% becomes the baseline the whole financial system gets measured against. Think of it like your body's resting heart rate. Everything adjusts around it. If a totally safe bond pays 4.5%, your mortgage has to cost more than that. A business loan, more than that. Even stocks have to prove they're worth more than a guaranteed 4.5%. So when this number moves, it's not abstract. It's your mortgage, your loans, your raise, your savings, all reacting to one underlying pulse. To understand why money feels different now, trace it back. What you're feeling isn't random. It's a 40-year trend that just snapped. Rewind to 1981. The 10-year yield hit almost 16%. Inflation was out of control, and the only cure was brutally high interest rates. Then, for the next 40 years, this number fell, from nearly 16% interest rates down to a record low near 0.5% in 2020. An entire generation grew up inside that falling trend. Cheap money became normal life. That's the world every piece of money advice was written for. And here's the diagnosis most people miss. That world ended. From nearly 16% in 1981, all the way down to 0.5% by 2020. In 2022, the 40-year trend broke. Hard. Inflation came back for the first time in decades. Rates were pushed up at the fastest pace in a generation. The 10-year shot from under 1% to over 4%, and it's stayed there ever since. And in 2026, it's not calming down. Producer prices just hit 6.5% over the year, the hottest since 2022. Markets that spent years expecting rate cuts are now asking about hikes. This is the real cause of that falling behind feeling. The terrain changed under you. Analysts call it higher for longer. The cheap money era may genuinely be over. 40 years down. Then, in 2022, it snapped and shot straight back up. Let's make this concrete, because this is where it hits your actual life. Your mortgage shadows this number. The gap between a 3% and a 7% mortgage is hundreds of thousands of dollars. Same house, completely different life. Car loans, student loans, credit cards, all heavier when this number's up. But here's what nobody tells you. If you're a saver, this is the best environment in 15 years. Savings, CDs, short-term treasuries, finally paying real money. The same force squeezing borrowers is quietly rewarding savers. So here's the prescription for a higher-for-longer world. 4 moves. This is education, not advice. Your numbers are yours. 1. Treat variable rate debt as the injury. Anything with a floating rate quietly gets worse over time. Attack credit card balances first. Lock in fixed rates where you can. 2. Stop letting cash sit numb. Idle money in a 0% checking account loses to inflation every single day. A high-yield account or short-term treasuries now actually pay you to wait. This is the single easiest win available to you right now. 3. Recalibrate your expectations. The effortless gains of the cheap money era were a symptom of falling rates, not a law of nature. Profitability, quality, and diversification matter again. Don't budget your future on a trend that has already ended. 4. Just watch this number. You now understand the system's heart rate. And that alone puts you ahead of almost everyone else, the ones still budgeting blind. 4 moves: kill variable rate debt, wake up idle cash, reset expectations, and watch this number. So when money feels hard even though you're doing everything right, this is a huge part of the diagnosis. It was never just discipline. It's a 40-year trend reversing under your feet. You can't control the 10-year yield, but once you can read it, you stop being surprised by it, and you start building around it. This is what we do here every week. Find the root cause, then the protocol that follows. If that's useful to you, subscribe. Find the cause. Deal with it. See you next week.